Thanks for joining us. Today I'm speaking to Maria Leftakis, who is the CEO of Morrow Sodali. Maria, it's great to talk to you.
Likewise, and thank you for having me, Tom.
No, it's a pleasure. Now, for people who aren't familiar with the work of your organisation, tell us a little bit more about what Morrow Sodali does.
We're a consulting firm, a global consulting firm, and we work with listed companies all over the world. In fact, we have 700 clients. And what we do is we provide corporate governance advisory service and also shareholder engagement. So really helping to equip listed companies to engage with a broad constituency of investors on their registers. And that's across annual meetings, M&A transactions, etc. So in the US S&P 100, about 40% of those are our clients, and in Australia, 1 in 3 ASX 300 clients, or companies we work with.
Well, you must have been kept quite busy recently because we're getting towards the tail end of the AGM season locally, which is a really important time of the year. What have you seen as the main themes coming out of those meetings?
Look, 3 things primarily, which usually tend to be factors in the AGM season, but one that's really on the rise is accountability at board level. So investors are really looking to try and hold individual directors accountable for performance. So this AGM season so far, we've seen 30 directors in the ASX 300 attract more than 20% against their re-election, and some have actually attracted more than 40%. With remuneration in the ASX 300, we've seen 16 strikes, so that's companies that have recorded more than 25% against their remuneration report. And in fact, over half of those have had dissent above 30%. So remuneration remains a hot topic for investors. And finally, really the biggest change has been the increase in ESG activism. So that's activism around environmental and social issues, with the number of proposals almost doubling from last year, from 17 to 31.
Wow. So what is your feeling in relation to that dynamic between shareholders feeling like they can actually hold boards to account? Shareholders feeling a little more encouraged by that mechanism?
Look, I think what's happened is in the past, shareholders were quite conservative. They viewed the board as a collective, and they felt it almost unfair to single out an individual director and hold them accountable. That's well and truly changed in the climate we're in at the moment, particularly around post-Royal Commission, looking at the conduct of executives, how stewardship is exercised. Investors are much more emboldened to single out directors and hold them accountable. So that's been a huge change. That thematic has been growing over the last few years. And in fact, we see the association in Australia that is the Association for Superannuation Funds, the Australian Council for Superannuation Investors, actually has a policy where it's seeking annual director elections. So there's an appetite to have directors go up and be held to account annually, as opposed to on rotation every few years.
I suppose when you use the expression accountability, so often that is intrinsically linked to the financial performance of the organisation, but that's almost being moved to one side now. Cultural issues, ESG performance, things like that are gaining prominence. Where do they sit now in relation to financial accountability?
Well, in fact, they're not separate things. What you'll find investors will tell you, and what is actually true, is that the way a company manages risks and opportunities around its environmental issues, climate change, etc., around its social risks, which is how it treats employees, and its conduct, has a direct impact on its financial performance. And so a lot more value is sitting in intangibles as opposed to financials, and this is what we're seeing really come to the surface this season and in the past few years.
When it comes to investors assessing an organisation from a risk perspective, we've got the traditional measures, but now it's almost become the case where if an organisation isn't current in its thinking, that's as big a risk as anything else. How does an investor go about putting a filter on that and working out where an organisation's compass is in relation to ESG, for example?
Yeah, it's a very good question. It's a difficult thing to touch and feel. a lot of it comes down to one thing investors can see is what a company says, and that's many times through its disclosures. And this is where we find that having disclosures like a sustainability report or a remuneration report or an annual report, that's all well and good. But do those disclosures clearly articulate the company's strategic objectives, the links to how it's incentivising its executives and the outcomes that are generated, which should build shareholder value? And we tend to find that sometimes those links aren't there, or the outcomes don't match the experience a shareholder will have. And so it's not having the disclosure, it's really about having a meaningful and compelling disclosure that clearly articulates strategy and then the frameworks to manage and deliver on that strategy.
I know it's probably difficult for you to put a view on this, but are there any organisations or sectors that you feel are doing this particularly well?
Look, a lot of our big companies have they've given it a lot of thought. Some big miners like Rio and BHP do a great job. CBA has been recognised as doing a great job. Woolworths and others. Now, they're not without some agitation from shareholders, but there is definitely evidence of consideration to how they're articulating messaging, how they're thinking about the future, and how they're showing that in their disclosures. There's some examples.
So within all of this, with a greater focus on shareholder engagement, proxy advisors have risen in prominence as well. I suppose that can be a good thing, but there are also some perhaps less flattering aspects to this.
Look, I think proxy advisors attract a lot of attention. Really, at the end of the day, they're putting out voting recommendations on whether a director should be re-elected or elected, and whether or not investors, their clients, which are mainly institutional shareholders, should support remuneration report and incentives. There's nothing more sensitive to a board and management reputationally and from a whole range of other perspectives, because it goes to the heart of their stewardship and how they're doing their job, but what the recommendation is. And so where it's negative, that is quite confronting. We tend to find that negative recommendations always make their way in the public domain. What we found is that investors have become much more sophisticated. Perhaps a decade ago, there was blind following of proxy advisor recommendations. But with such huge investment by a lot of our super funds and index funds and others in their own governance analysts and teams, the proxy advisor research really serves as an input to highlight or flag potential issues. And so what we find is that if a company is extensively engaging throughout the year, year on year, not just when it has an issue or a negative recommendation, it's that relationship and that trust and loyalty with its investor that will help it secure support. Proxy advisors will have an impact, and it is research after all, but that can be managed to get the best outcome possible for the company. But I do know it's quite a sensitive issue. It
is indeed. So like for the average investor, what sort of pointers do you give them to navigate this field, which can sometimes be a little bit murky?
That's another very good question. I think Australia has the highest level of shareholders in the world by virtue of our superannuation regime and system. And what I'm always intrigued by, when you look at retail shareholders as a collective, they're probably the largest group or constituency on any register, yet engaging and motivating them to exercise their vote is really challenging. And that's generally because they don't feel as comfortable or equipped across the detail to perhaps vote, or they might think that their vote doesn't count because their shareholding is small, but it does count. And what I would encourage retail shareholders to do is to take some time to be looking at the key information in the annual report. Most companies are great at putting out information, alerts, etc., but to also be reaching out and asking questions. Companies big companies are resourced with investor relations departments. They're very happy to take calls from large and small shareholders. So really, there needs to be an effort to you know, put some time into making your vote count and really trying to protect the value of your investment as well.
And it's a good way of making you feel as though you're an actual stakeholder in the organisation.
Sure. Yeah.
Maria, it's been great talking to you. Thanks for your time.
Likewise, thank you so much, Tom.
And thanks for joining us for the Executive Series.
Thank you.